Real estate investing with as little as $1. That's the narrative pushed by the Canadian crowdfunded real estate investment platform Addy that you may very well have heard of on my own YouTube channel or on other Canadian finance YouTubers' YouTube channels near the end of 2021 and in early 2022. In fact, there was a period around January, February of 2022 where Addy was heavily promoting their platform through popular social media channels, creating quite a bit of buzz around this newer low barrier alternative to traditional real estate investing that traditionally required quite a bit of capital on hand, which is really just the name of the game when it comes to real estate investing. I even had the chance to go down to Montreal, meet with the founders of Addy and the developers on 2 of the newly launched boutique hotels on the platform. It was a fantastic weekend, and the projects and company as a whole really seemed like they couldn't have a more bright future ahead of them. Well, fast forward now almost a year later, we don't really hear about Addy all too often, right? And as with most fintech companies right now, advertising budgets are cut to near all-time lows, and with significantly less properties actually dropping on the Addy platform for investors to invest in, well, this leaves a much smaller window of opportunity for content creators such as myself to make content about the platform organically. But here's the thing, as someone who has nearly $4,000 of my own money invested across properties in the Addy platform, well, I wanted to make an update video on what's been going on in my own portfolio, and I also even reached out to the founders to get a bit more insight on what's been going on at Addy behind the scenes over the last year or so. Let's get into it. Alright, so if you aren't familiar with Addy, let me give you a bit more context before we dive into things. Essentially, Addy is a fintech company that acts as an intermediary between everyday investors looking to gain exposure to the real estate industry without physically buying real estate themselves, and real estate developers who are looking to raise capital to bring their projects to life. So this means that while Addy may very well choose to gain financial interest in a property that they're actually listing on the platform, they're never going to be the ones actually managing the development of the properties themselves. Again, they're simply an intermediary between investor and developer, thus facilitating the transaction by dealing with the securities regulators and issuers of those $1 shares that they then offer out to retail investors. That's how they make their money. They're charging an upfront membership fee to the front end user and investor, but then also charging a back end fee relative to the amount of capital raised, and that's distributed out to the developer. That being said, I did mention last year and stand by my statement that an investment in an Addy property isn't real estate investing. Here's why. The reason why real estate is such an attractive asset class is because it allows for a plethora of different ways for the investor to create income and value for each given property that is then amplified by utilizing leverage to buy a property in question. Cash flows, debt paydown, and tax write-offs are all fantastic benefits that real estate has to offer, but it's really through utilizing leverage and loans that 90% of real estate investors become millionaires over time, period. So when you're approaching an investment in an immovable asset like the ones on Addy, it's important to understand that in respect to your own investment in the deal, not what's going on behind the scenes in the developer's financials, well, you don't really get to take advantage of the benefits that we just covered to the same extent. Rather, what you're banking on is what's advertised on the platform for each property, being the internal rate of return, otherwise known in the industry as the IRR. And without getting too complicated, this essentially looks at a project's future value and divides it by its current value to come up with a yearly return figure over the course of the project. But in reality, there isn't really the concept of a yearly return for projects such as these ones, because everything is based on the future value of either a refinancing or of a sale of property for the exit strategy on a given deal. And all of that isn't really calculable down to a yearly basis, especially considering the fact that future values are extremely difficult to predict. Now, to be fair, this isn't anything against Addy. Most real estate developers tend to use the internal rate of revenue when raising capital because you still need to provide investors with average yearly rates of return. Otherwise, it would go a little something like this. Hey, yeah, how's it going? I've got a new property. Do you want to invest with me? Yeah, probably. What do the expected financials and returns look like though? I actually have no idea. I'm just going to wing it and see what's left over at the end.
And it's gone.
Okay, jokes aside, there's nothing inherently wrong with providing investors IRR values, but as investors, it's important to take these values with a grain of salt and understand just how tricky it is to estimate future property values 5, maybe 10 years down the line, especially in the current market environment when interest rates are high and quite uncertain, and when the whole exit strategy depends on a future refi or sale value. But anyways, I digress a bit here. Getting back to owning shares of an Addy property, property. As an investor, you need to understand that you really have no say in what happens in the property, even though you are an equity investor per se. But anyways, this is what most investors on the platform are looking for anyways, a hands-off way to gain exposure to real estate. The thing is though, what this essentially means is that although you do technically own equity in the Addy property, well, this is more of like a glorified expected capital gain that you're going to receive for basically loaning the developer money for a given period of time. So this really does differ then from a traditional equity stake in a property or even a traditional fixed income or interest-based investment where you're getting an expected and calculable rate of return based on your loaned out capital. This is sort of a mix of both where because you do technically own equity in the Addy, well, your payout at the end is going to fluctuate based on the refi or sale value at exit. And the reality though is that with interest rates having gone up and now staying quite high, this impacts any real estate development project, including my own that I'm doing personally, but then also basically every property that's going to be available on the Addy platform. So to summarize, in respect to Addy and this type of crowdfunded real estate investing, I've always said and maintained my position in that it isn't real real estate investing. Rather, I view it as an alternative investment category that happens to invest in real estate. But with all that said, let's now take a look at my own Addy investment portfolio. All right, so within the Addy app here, we can first and foremost see the wallet page. So in the wallet right now, I have $578. This is actual cash that is in my wallet ready to be invested into an upcoming Addy if I choose to do so. Now in this page, we can also scroll down, and one thing that's new since the last time I made an update on Addy in general is the fact that there's a distribution in the JS Colton Fox building for $3.06. Now we'll take a look at that in more detail shortly, and you might be wondering, well, $3, that doesn't seem like much. However, I'm pretty sure I only invested around $300 in this property, and it has a term of a couple of years with multiple different distributions scheduled for this property during the holding term. So that's why $3 is the distribution that I got on January 12th of 2023. Now, moving forward, we can also see if we go to the home page, we can see the feed with 2 current properties. Actually, there's only 1 current property. I'm pretty sure there's one dropping like next week or so by the time this video comes out. We have the Castle View Park property that's raised just shy of $800,000 of their $1.5 million goals. Prop drops, yeah, so that's exactly what I thought. There's a new building in Calgary that will be dropped shortly, and they're looking to raise $500,000 for that building. So there definitely has been a significant drop in the amount of Addys that are being released on the platform, but as I mentioned earlier, it's pretty much going to be as a result of the fact that interest rates are a lot higher, and for most developers, the viability of most projects is diminished, which is the reason why we're seeing a lot less development lately and a lot less transactions even on the MLS. All of this plays together. Now I'm going to go into the portfolio tab right down here. Clicking on that, we can see that I have a total invested amount of $2,871, and that's actually across 8 specific buildings here. Now, it's kind of an interesting way that they've made this essentially the app. They have all the buildings that you've invested in as this little prop, they call it essentially, and you can click on this and see the address, the amount that you've invested, and your percentage ownership for each one. So, for example, that one was, I think, around 15%. This one I own 0.1%. in theory and on paper. Now, that being said, the only property that's actually had any development since investing in them is that JS Colton Fox building right here. So I'm gonna click on that. Actually, no, we need to scroll down so that we can get some more information. So clicking on that, we can see a bit more information about each one. So for example, return of capital, $3.06, capital gain 0 yet because the actual term for this property is not yet completed. But we can also see, $3 return is estimated IRR of 12.15%. Again, though, that will depend on what the building will be worth at the end of the term, as well as some other information, my investment, the distributions, and so forth. Every update for each property that you're invested in will be on the actual page itself for each one. All right, now at the beginning of the video, I mentioned the fact that I actually reached out to one of the founders of Addy so I could get him on FaceTime and ask him a couple questions about really what's going on behind the scenes at Addy, since we haven't been seeing the same momentum and volume of properties dropping on the platform. Here's what he had to say. So first and foremost, the main reason why there's significantly less properties dropping on the Addy platform, which really does make sense, is the fact that interest rates are significantly higher. Now, in the world of real estate investing and development, interest rates, like I mentioned earlier and in my dedicated real estate videos, have a massive impact on the value you can get for financing, as well as the values you can pull out after refinancing a deal or selling it when the project is completed. In fact, this is exactly what's happening even in my own properties, where when acquiring them, say a year or 2 years ago, when interest rates were at 2-3%, well, the values for financing are way higher than now. Fast forward a year or two, once the interest rates baseline rate is at 4.5%, and mortgages are also hovering around those interest rates. And so for new properties coming on the platform, especially for BRRRR style properties where you're acquiring one, renovating the unit and the building as a whole with the goal of upping its market value, well, the amount of properties that are actually viable for this strategy are significantly fewer and far in between. Same goes for full-on new build construction. With higher interest rates, well, financing rates are a lot higher, and it becomes significantly less profitable on 90% of deals for developers to actually go through and complete projects. That really sums up one of the main reasons why there's a much lower deal flow right now. Additionally, what he mentioned to me is a new feature that they've been developing and building out that isn't yet available, but essentially they're expanding into the US, their footprint. So as a Canadian, you'll be able to actually have a Canadian dollar as well as a US dollar account, essentially wallet in this case, where you can fund these two different accounts with Canadian and US dollars in order to invest in US property. So that's somewhat exciting to have a property coming in Oklahoma City. Whether or not that is a good deal or not, I have no idea, but that is a feature that if you're interested, you can keep your eye on. Other than that though, not too much has actually changed behind the scenes for the Addy platform, other than the fact that the pricing structure has actually migrated from a fixed $25 fee to now it's either free or $50 per year, and that is going to allow you to essentially invest more into properties than with a free tiered account. And finally, he also mentioned that over the coming months, there should be a higher flow of properties dropping on the Addy platform. So if you're a user already, definitely keep an eye out if you're interested in investing into more of these properties. And if you're not a user yet, well, you could also consider opening up a free account and keeping an eye on any property that might be of interest to you over time as they trickle down on the platform. By the way, if you do sign up down below using my link, you can get $25 for free when you sign up. So essentially, that's $25 for free that you can choose to withdraw if you never end up investing in an Addy property in the first place. So all that being said, Addy still has released a handful of properties over the past 12 months and doesn't have any indication of not moving forward with any of the current projects that they've sold to investors, at least for now. As a final point for this video, I've said it in the past and I'll say it again right now. As with any investment, it's really important that you fully understand the risk associated with it, as well as consider the implications of a given investment over another. In this case, well, an investment in an Addy property is highly illiquid, and for the most part, for the duration of the intended hold or development project, you don't really have access to that capital, which is locked up in the property and with the developer. So if that's something that might be a challenge for you, if you need any type of liquidities that you'd be putting in one of these properties, this probably isn't right for you. Additionally, understanding that this is very much a higher risk type of investment, that is critical to understand in order to have proper asset allocation to higher risk investments in your broader investment portfolio. If you made it this far in the video, thanks a lot for watching all the way through. I really hope you enjoyed it. If you did, please drop a like, and don't forget to sign up potentially for Addy down below. You can sign up for a free account and you don't even have to invest in anything if you are never interested in a given property, but you will get $25 for free if you sign up using my link down below in the description. So thanks a lot for watching, and on that note, I will see you in the next one.